to another episode of Inspire Wealth. I am your host, Mallory Meehan, aka Prof M, and I am joined by Tom Burns today. Tom, how are you doing?
Great, Mallory. Thanks for having me on.
Yes, I'm really excited to kind of dive into how you got into real estate because you have a really interesting story. And something that really speaks to me is you put a lot of time into your education and your schooling, but realized that there were other alternatives, that you could be exploring. So, Tom, with that, why don't you give us a little introduction, a little background about yourself, and maybe how you got into real estate?
Sure. Tom Burns. I live in Austin, Texas. It's 106 degrees today. So happy to be inside. I grew up in Austin. My dad was a federal cop. My mom was a nurse. And, all I did was play sports. And that's all I did. I joke that I played sports and chased girls, but I was only successful in playing sports. When I found out that nobody was going to pay me to be an athlete, I decided to do the next best thing, which was to find a way to hang around athletes because I understood them and that's all I usually did. So I became a sports doctor. I became an orthopedic surgeon with a sports medicine specialty. So in order to do that, you do med school, you do college, you do med school, and then we do an apprenticeship program, which is 5 or 6 years of training under established doctors. And so it was there that the real estate journey started, Mallory. I was about halfway through that 5 or 6 year stint, and I started noticing the people that were teaching me. And these were people that I was supposed to be in 10 or 20 or 30 years. And they were unhappy. They were in the hospital late at night. I had to be there because I was an indentured servant, but they were late. They were there late at night, didn't like their job, complaining about not having control, many of them on their second or third marriage. And that happened enough times that I claim it as either luck or touched by an angel, but I decided that I didn't necessarily want their money if I had to have their life. These guys had fancy cars and big houses, but they were not happy. And my plan was to be happy. So I searched for a lot of stuff. And to keep the story short, I landed on real estate because it's pretty simple. It's just math. And it moves slow, and you can do it part-time or full-time. You can have partners, you can do it on your own. So it's not like I started buying stuff then because I was what they call a resident. So I didn't have two nickels to rub together. And so all I had to do was learn. So I talked to people that did that, and I read as many books as I could. I got out of my training and started becoming a doctor in private practice. After paying a few bills, I did the only thing I knew at the time because as you and I talked before you turned the recorder on, the internet hadn't yet gotten going yet. So I didn't know what else to do. There weren't any syndications to invest in, and there weren't seminars, there weren't courses. So I went and bought something. And basically, about what I knew at that time was kind of how to do the math. So I looked in the newspaper, and for your young listeners, that's like a physical computer that you hold in your hands. It's made out of paper. But on the back of that, there was an ad that said, condo for sale. So I went down, called the guy, went down, looked at it. He was the broker. Turned out he was also the property manager. Anyway, we made an offer, and he said, "Let's make an offer." I said, "How do you do that?" He said, "I'll do it for you." And we won the deal. And I said, "Great. What do we do next?" And he said, "You got to get an inspection. You got to get some stuff, and you got to get this and that insurance, and you got to get a loan." I said, "Awesome. How do I do that?" He helped me through all of it. I called a banker friend, didn't know anything about what I was doing. I said, "I'm buying something. I'm supposed to get money from you." He said, "Great. Give me 2 years tax returns and your cash flow statement and all this other stuff." And, I practically got mad at him because he kept asking for stuff. So I say it like that because it's not rocket science. You don't have to know everything before you start. I literally almost knew nothing, and everybody held my hand, and through a lot of teeth gnashing and me learning some lessons, I eventually got this property. Not a big one, but fast forward a month or two, and it paid me $100 or $150 a month. I was a doctor at the time, so I had to see patients to get paid or do surgery to get paid. But every month that, $100 came in. I thought that was pretty cool. I started developing a little addiction, right? A good addiction. So I called this broker up and I said, "Hey," by the way, he was managing my property because he did both things. I said, "Hey, this is pretty cool. You got another one?" He goes, "Yeah, I got one down the street." We went and looked at that one. And I still learned a lot of lessons, but happened a little bit faster because I knew some stuff from the first property. So I bought a bunch of those. I got so good that I knew that market like the back of my hand. I bought one sight unseen. I bought one for no money down and actually got paid at the closing table. I don't recommend that, but I knew more about the market than the seller and the seller's broker. So that's how things got started. Small property. All I was doing was putting things in the asset box. If any of your readers have read Robert Kiyosaki's book Rich Dad Poor Dad, he's got a graphic that shows income and expenses and then assets and liabilities. All I wanted was stuff to put in that asset box that would create some income that would go into my income column. So I bought some discounted notes. I bought some mobile home property. I bought a cell tower, which was awesome. Uh, so I just did those. I was just trying to get a little extra income. I loved my job. I loved being an orthopedic surgeon, but it was awful nice having a little extra income come in. Well, that started changing things a little bit. Uh, Unless I'm talking too much, I'll continue with the story. But uh, it wasn't life changing, but there was a little bit of money came in, and it changed my head a little bit, such that instead of working 5 days a week, I decided to take Friday afternoons off just 1/10 of the week. And I still, I was a doctor, so I worked on weekends too. But all of a sudden I had Friday afternoon off, and you'd have thought I was Bill Gates because I had a 2.5 hour, 2.5 day weekend when I wasn't on call, and that was a big deal to me. So that addiction kept feeding itself. Well, I got to a point where I had a nice little personal portfolio, and it was growing, and it was certainly cash flowing. It was really nice, but I wanted to do more. I felt like I was bumping up against the ceiling. And so I had a friend who was in the development world. We had vacation together. He was a buddy of mine. I went to him and said, I like what you do. Will you teach me? And for you professionals out there, he looked at me and laughed and said, you're a rich doctor. You don't need to know this stuff. I said, well, teach me anyway. So I didn't pay him, but I took time off of work to do things, and I worked for free. So it did cost me. And I worked for him for about 18 months for free. And we built, we built some stuff for banks and did build-to-suits and things like that. I didn't make any money from it. I was just learning. But out of that came a project that he and I did together. And we built a 150,000 square foot medical office complex together. And we still own that to this day. We've owned it for over 20 years. So I learned a lot about development in that process. And things were growing. I was adding to the asset pile. And by then, I had some folks that would put me on stage to talk once in a while. And I was speaking in Phoenix, and at the break, somebody came up and said, hey, I'm moving to Austin, Texas. Will you be one of my contacts? I said, sure. And 5, 6 years later, he becomes my partner. And so we started a company in 2008 or 2009, right in the middle of the GFC. So that was pretty stupid, but it worked out. And we started building apartments. And so, there's always something new to do in life. Now I've kind of toned it back down. Now we're just, taking the focus off development. I'm just acquiring existing properties, fixing them up, just the same old story that we did during the boom days of the 20 teens, right? You could throw a dart back then and you'd make money. Now it takes a lot of work and takes a lot of foresight. So that's the long sordid story of my real estate career. About 15 years ago, I was making enough money in real estate that I didn't need to be a doctor, but I so much enjoyed my practice that I kept doing it. The reason I enjoyed it, this is maybe for your listeners, the reason I enjoyed what I did was I made enough extra money on the side that it didn't matter what happened at work. And so I could eliminate a lot of the annoying things and not worry about how much it would cost me. So I really loved being a doctor, and it made life nice. The only reason I retired was I ran out of time. And now here we are talking on podcast.
Yeah. Well, I love that. And I think that that's a great lesson to say is that once you can take out, some of those hindrances that you have in a job that you don't have to stress about, that you don't have to worry about, your passion is able to come out more, and you're able to fully enjoy what you originally wanted to do when you maybe take, the money component out, or you take the necessity to be on call all the time out, so I think that's a really good point to make. You can still do what you enjoy doing as long as you can maybe revise how you're doing it.
Right. And people, people get discouraged. They think they have to make enough money to retire from their job if they don't like it, but not everybody dislikes their job. You just need to take a little pressure off. It makes you smile more when you've got a little extra income coming in that you can sleep or vacation and that income will still come in.
No, I love that. And, I think time is one of those things we'll never get back. And all of us all have the same amount of it every
Right.
single day. So I think finding new ways to bring more time back in your day or, give free up some of that time is definitely a way that most people want to live. So I know that you had mentioned that you wrote a book. So
Yep.
can you tell us a little bit about your book and what prompted you to want to write a book?
Sure. I was not planning on writing a book. There's a lot of stuff I wasn't planning on doing. It just happens. But a friend of mine is Robert Kiyosaki, and I have been friends for 27 years. So, and he wrote the number one personal finance book ever, Rich Dad, Poor Dad's sold something like 45 million copies. So he and I are at his office having lunch one day, and he looks at me. It's not my fault, So I looked at him and I said, "So what's your next book?" Because he was putting out about a book a year. He'd always put something out. And he told me, and he looks at me with a mouthful of salad, and he says, "You should write a book." I said, "No, I don't want to write a book." He goes, "Oh, you got a story. You should write a book." I said, "Well, if you can, I can." So, and he looks at me and he goes, "And you could call it Why Doctors Don't Get Rich." And he meant it in one way, but I kept that title and tested it for 2 years. I wrote that book over 2 years. I wrote every word of it. I had editors that looked at it. I had ghostwriters. It was just a passion project to give hope and guidance to people that want to do what you teach and maybe a little bit of what I've done. And that title is really a great metaphor for the fact that no matter how much you get paid per service or per hour, if you get sick or you get hit by a bus, the music stops. So it's really helpful to have some passive income that comes in, whether you're sick, hit by a bus, sleeping, playing with your kids, vacationing. So anyway, so I wrote the book, and I published it, and I didn't, I did the worst marketing job in the world. I never told any of the podcasts I had a book coming out. I uploaded the book one day, and 6 days later, I left the country to go do something in Turkey, and but still, it's in like 15 countries now, and it, does a pretty good job. It's not just for doctors. It's really about how to think about passive income and some things to think about, and think about taxes and things like that. So it was a real passion project. I really enjoyed it, and it opened a lot of doors I wasn't expecting to be open or had asked to be open, and that's really what caused me to end up retiring from medicine because I got a little too busy.
I absolutely love that. And I'm a huge fan of Robert Kiyosaki and the Rich Dad Poor Dad group. I think I have read almost every book by somebody affiliated. So I asked what your book was called. I've already read your book. So um I'm really honored that you're actually on the show and that this is like a full circle for me right now.
Oh, thanks.
My one of my targets are high income earners who just don't know how to invest their money. So they've been so used to getting paid for their time and getting, income based off of that, whether it be a doctor or attorney, accountants, CPAs, CEOs, all of these people that are getting paid for time versus actually understanding how their money could make them money versus them having to make money.
Right.
One of the best things, especially to understand for maybe high earning income earners, like you were alluding to, is taxes. So tell me about how you think of taxes and maybe some of the key concepts that you utilize or you're now instituting, and maybe your other doctor friends. What advice do you give them when they're asking about taxes?
Sure. Was it Justice Learned Hand said there's no obligation to pay taxes. We are allowed to avoid taxes. Uh, uh, just can't dodge taxes. Yeah, I think taxes are important, and it's great to have them for roads and sewers and things like that. But I want to pay as little as possible and as little as legal. And so in my journey, I was a I owned my practice, but I paid myself as a W-2 employee. So it's not a lot you can do as a W-2 employee. There are some things, but not as much as if you work for yourself or if you've got some real estate. So as I started buying real estate, I started getting these K1s, which I had to figure out what they were and I had to understand why that negative was a good thing for me. But after a while, I used to run through the house and show my wife how much money I lost the year before and had to explain to her why that was good. And what I mean by that is, there's a lot of deductions in the real estate world. It's a great way to shield your taxes. It's a great way to harbor your wealth and a great way to grow your wealth most of the time. So, um, if you can, depending on how much of where your income comes from, you could start lowering your tax bill. And as a W-2, my blended rate, as I got more and more real estate, my sort of blended tax rate started coming down. And uh, you can that a lot of the hires are not going to believe this, and you can't necessarily do it very well when you're still working, but you can pay zero taxes. You can make millions and pay zero taxes for that year. Uh, I can promise you that. I've done it. You want to be proactive about it. Um, if you just have a W-2 job and you go to your tax planner, they're going to say there's not much we can do. There's a few things. There's some oil and gas, which helps you write off W-2 income. There's a few other things, but that's the main one. And there's risk to that. You never want to do it just to write off the taxes because it's still real money. Uh, but I would tell everybody, yes, I'm certainly a real estate homer. I've invested in other things, but you get enough real estate, it starts shielding a lot of your income. And if you are a professional and you have a spouse that is maybe not working or has lots of time, there's something called real estate professional that you can work on. You have to really dot the I's and cross the T's, but you can start making your income come in at capital gains rates instead of ordinary income rates. That is a huge, huge gain for a high earner.
Absolutely. And that is one of the things that I tell a lot of my colleagues is that, if they do have a spouse that is staying at home or, maybe just works a part-time job, they can be the manager of the assets and they can be the ones getting that 750-hour requirement to be the real estate professional and really be able to offset a whole bunch of other income. And then you spoke a lot about passive. And so it's interesting, when people think about money through real estate, they don't necessarily understand the difference between passive and active earning. So, can you dive in a little bit about your understanding and maybe how you explain that kind of income?
Yeah, and I'm not a tax guy, but I can tell what I assume. Well, first there's the big thing, active and passive. I mean, just the descriptions. You got to go in and you got to take a client, I got to take a patient, and we get paid for that. Passive income basically means that you're not actively managed in the process that's making those returns. So, like I said before, you can be doing anything, you can be anywhere in the world, the passive income will still come in. From a tax standpoint, uh, you know, we've got the laddered tax structure for people that make a certain amount of income. So your adjusted gross income is going to be relatively high if you're a high earner. There aren't a whole lot of deductions against that. Uh, you do get the junk taxes, the FICA taxes, Social Security, Medicare, things like that. That comes on your W-2. Usually, I believe you don't usually get that on your passive income. Okay, thank you. Just making sure. And it's just taxed less. And if you buy and sell something, you keep it for a year and a day, you get long-term capital gains, which is 20% plus the Obamacare stuff. That beats 37% plus the Obamacare stuff. So you pay a lot less in taxes. And then you do get, if you get income during the year, it's less than a year, it probably gets taxed at ordinary rates, but without the junk taxes. However, if you own a piece of real estate, first year or two or three or more, depending on how things get set up, you might make income, but you pay zero tax on it because of the beauty of depreciation and cost segregations and bonus depreciation, accelerated depreciation, wherever we are, in that point in the cycle. So you get to keep, a lot of early on, you get to keep every dollar that comes in. So that is a big deal. If you get to keep those dollars today, they're worth the most, and you can do something with those instead of paying taxes on them. You can go reinvest them into something else. Like I tell people, I said, make money off your money and have that money start making babies, and have those babies start making grandbabies. It does compound, and it's an exponential kind of return. If you continue to put everything back into the golden goose and let it just keep doing its thing with compounding, it will grow surprisingly, not very fast first few years, and all of a sudden it'll grow like crazy. And the
Well,
tax, paying less tax helps.
absolutely. So you started out by buying a couple condos and you hired a property manager to take care of those, correct?
Yep. Yes.
And so then your next step was getting into a partnership, is that correct?
Well, I bought the condos, I bought a cell tower, I bought some, I bought some bank note, some not some bank notes. I bought some, owner finance notes, things like that.
Okay.
A little bit of a little bit of manufacturing, but yeah, just small stuff like that. And then I bought a small apartment complex, which actually I didn't know what I was doing, and I was lucky to get out of there with my shirt. Probably worth a lot of money by now, but I didn't know what I was doing. Then I bought 40 units. Instead of buying one at a time, I bought 40-unit condo complex. So, but yeah, it was about that time that I thought that, I need to learn something. I need somebody to teach me something. So I looked for a mentor. Yeah, that's when I did it.
Yeah, I think that mentorship is so important, and especially a mentor who's going to pave the way for you. And, I
Right.
think when you find somebody who not only possesses the knowledge or the willingness to teach, but also the willingness to show you on the job and actually, diving in, because I think a lot of people look at real estate and they see, the flashiness, they see the high upside, but they never kind of take a look at the downside and like how things can go wrong fast. Like you said, you probably should have got out of that apartment. I'm there. I feel like there's a story there. So can you fill us in on what that story might have been?
Oh, well, that one, that was really long ago, and truly, it would have been worth a lot if I'd have kept it right by a university, just small, 22 units. It's not a horribly instructive story, but there was about half of the complex was filled from a center that was like a halfway house or something, and they would put people in there, and it was what now I realize is over market rent. And and so that's one thing that happened is they stopped that very soon after I bought the complex. Thank you very much. And then I searched for what I thought, I searched my network and asked people who was the best manager in that town. It was just 22 units, so certainly couldn't be on site. And I found the guy, I talked to him. He put his son on it, his 21-year-old son instead of him. And that guy was terrible. So we had an owner who didn't know what he was doing. I lost, a third or to a half of my tenants, and the manager was just collecting his fees and not doing anything. So finally, somebody came in and bought it from me, and I don't know what they did with it, but it's probably worth a lot of money now. But I got my money out. So lessons learned to, watch your tenant base, understand what the market rent is, and management is super key. I should say that about 4 times. Management is really important.
100%. And I tell everybody who's thinking about getting into, a larger portfolio, once you kind of get over that 1 to 3 properties, especially if they're not within a drivable distance to you, at that point is when you really need to consider hiring somebody who's going to help manage the day to day. You're not going to want to take calls on the toilet isn't working, or the tenant got locked out of their house or whatever. It's totally worth what you would pay a good, to your point, a good manager to help manage that. Um, do you have any other like stories that kind of are lessons that strike you as good learning opportunities that you can share as, you know,
I've got so many. I've made so many mistakes. Certainly diligence is key. I got a friend who says, "Do the numbers will tell you what to do." It's certainly not my quote, and that's true. And you don't want to get enamored with any property just because it looks pretty. It's nice. That's a nice benefit, but the numbers will tell you what to do, and the numbers are the actual property numbers themselves. You need to know the local comparables, know what's going on around you, get a feel for how that property will do in the future, because none of us can really predict. You can just get your best idea. When you're buying something, as Ronald Reagan and the old Russian proverb would say, trust but verify. In fact, I would say when you're dealing with brokers and sellers, do not trust and verify, because everybody lies. And so make sure you know all the numbers. People are going to tell you, don't worry, that's not been a problem. We'll, get it verified. So that's one thing. Really know your numbers. And you're still going to make some mistakes, but if you've done a good job on the numbers, hopefully it's market forces that are a problem for you, or hopefully they're not. There's always ways to try to get out of that. What else am I am a huge fan of management. My very first property, I got a manager, and I did take one property that I managed on purpose, just so I would know maybe what they went through while I was managing my managers. It was not fun. It was a year, but I learned a lot. But that's, you make that point that, if you've got 1 to 3 properties, particularly if it's you or your spouse and you're trying to shoot for that real estate professional, you might want to be actively managing them, because you don't necessarily get credit if you're managing a manager. So that's a kind of a good point. But if I had my way and wasn't thinking about REP, I would never manage anything, because Mallory, I don't know about you, but I promise I would be a poor hire as a manager. I don't do the right background checks. I won't put in as good a tenant as a professional manager will, and I won't have to answer those phone calls. So they may sound like an expense, but they're actually an investment. They're going to put in a better tenant that might stay longer, might tear up your place less, and might actually pay their rent. So managers are an excellent investment. Uh, it's not bad to maybe manage a little bit to see what they do, but I'd try to move to that if I could. And the rest, this is a message for all your, as you said, your high earning professional uh, listeners, is that most people out there know you make a lot of money, and we're all told, hey, you should invest. I mean, I spout that all the time. You should be an investor. That you've got to create passive income. It's going to make your life better, and there's just a lot you can do with that. So we're all told, hey, we need to be investors. Well, most everybody out there knows that you have money to invest, and I will often caution people, especially as you said, the first time, move slow, invest small with new people, talk to other people that have invested with them. In fact, if you don't know anybody that's invested with them, get a list from them, and then ask those people who you might talk to, so that you get down to the people that maybe the sponsor didn't send you to. Because people can be, I'll just say this bluntly, there are people out there that would rather have your money than do a good job to grow your money. They're doing it maybe more for themselves. And I've been a sponsor for almost 30 years now. Our job is to grow your money. And if we grow your money, then I'm going to do very well eventually, not at the outset. So you want somebody that gets a little nervous when they take your money, because they know it's an obligation, and you get paid first and things like that. That's really important. So, don't let splashy Facebook pages and great deal presentations sway you. Make sure you look at the numbers, make sure you know who you're investing with.
Absolutely. And I think to your point with managers, sometimes people get too attached to properties. They get, you know, let's say it was an inherited property, or, it was their first property that they bought. They get too close of ties with it. And then when they're going through the day-to-day operations, it's not being effective. And having that manager as kind of the buffer between you and the property, I think is really, really key. Especially that I'm seeing a lot of boomers and their parents needing to go to homes, or people downsizing and then keeping it as an asset. If it was your personal primary residence for a long time, you have a lot of connection to it. But
Yep.
you can't just enter that home whenever you want now that you have a tenant in it. It's so there needs to be some degree of separation, and I think having a manager helps with that too.
It helps so much. I run a mastermind. One of my students was real proud that they were in real estate, and I was happy for him. That's 7 houses. Uh, I was excited. So we went through the spreadsheet and look what he had. But he was managing all 7. Very proud to be in real estate. And as we went through, he said, well, this is a nice old lady. She's been there for years. So, I don't raise her rent. Uh, this is a nice person here. I don't have him pay, because he was paying $104,000 a year to own those properties. And so a manager would have brought those up to market rent, would have gotten people that would have paid. So that's my point with management. And it's that separation that you were just talking about. So keep that in mind.
Absolutely, absolutely. So I am really interested in hearing about your transition from investing in the actual assets that are already completed, so the condos, the cell tower, and then you got into development. And so
Yeah.
that's an interesting transition. Obviously, it's not unusual, but tell me about how that transition occurred and how the development process kind of spun out.
You bet. So, my partner was, I chose him as a mentor because he'd been doing this kind of stuff for a while. He was a really good friend. He's just a good friend. I said, man, teach me what you know. So, I learned a bunch of stuff over that 18 months. And, he actually called me one day. And what happened was his mother's dressmaker lived on this lot and the street was getting too busy. She said, you got to get me out of here. So we started looking at it, and it was 16 lots on a hard corner in the most wealthy part of Austin, Texas, or one of the most wealthy parts of Austin, Texas. So we quietly put all 16 lots together, and we're trying to decide. And we were going to put like an office complex. He actually came up with the idea. He called me one day and he goes, "What about medical?" I said, "Yeah, that's a great idea. There was no medical out there." So anyway, it was, we was stumbling over each other, and so we decided to do a medical complex. We footed all the engineering bills and everything together. We went to city council. It was 18 months of begging city council until they finally said no after 18 months. And then the public got wind that there was going to be a medical center. The public went crazy. The mayor called us and said, maybe we should reconsider. So we built it. And I was in all the engineering meetings, all the planning meetings. I was the guy that was in there cutting extra parking spaces because all the people I was working with just didn't realize how parking intense medical property is. And we leased it. Because I knew a lot, we leased a lot of it ourselves. We didn't need brokers, which saved us some money. Uh, we filled that up, filled phase one up, and then we decided to build phase two. And to our disgrace, we founded and built a hospital as well inside. Was one of the tenants inside our medical complex. So I say to our disgrace, it was a great hospital. We won awards. We eventually sold the operating business. We still own the real estate and the dirt underneath them, but it was just learning by fire from somebody who really did know what he was doing. He was learning as well. I had the medical knowledge. He had the developer knowledge. We both learned about developing medical property at the same time. And like anything in life, we made mistakes and we learned from them, and we had some lucky hits, and it's now filled up. And like I say, it's been around since 2001, so we've had it for a long time. So learned a lot.
I love the connection of you building a hospital as a doctor. And I think
Yeah,
that is so cool in you being able to bring a different perspective too, because a lot of people, if you were a developer, that's all you've done, that's all you know. Different asset classes come with their own unique, you know, challenges and obstacles. So I think that that is a really, really cool thing that you were able to do. So I give you a lot of kudos on that one.
thanks. It was not easy. Building a hospital is not easy, and running it. I mean, we owned the hospital, so it was crazy. I brought in doctors, and we syndicated that. I brought in doctors, and that was hard. So, but it was fun. It was sort of fun.
Well, I'm going to touch on something that you brought up. You brought up that you were the one to go into the local government meetings and had to, talk to planning, talk to, that whole process. So I'm actually on our local planning commission here in State
Yeah,
College where I live. And
nice.
so I see the day in and day out. So our developers are coming in. I bring a different perspective, than other people on there. But people who are thinking development might be something that they're interested in, give them some of your kind of learning experiences when you're first, even before the project even breaks ground. Like, what are some things that they have to consider, things that they have to think about?
Oh my gosh. And I will say we had a kind of a split council, some people on the extreme end, and some on the other end. Basically we were told, we don't care if you make money, we don't want you to make money, that sort of thing. And every developer's there to make money. It's capitalism, right? But the things you need to think about, as I said, we put 16 lots together. So we had to go talk to all the people around the periphery and say, here's our plans. Here's the buffer we'll leave. So you have to leave a buffer between you and the neighborhood. You have to, best laid plans can be torpedoed by a strong, homeowners group, connected to next to your, adjacent to your property. So we talked to all them personally. So here's our plans. It's going to be quiet. It's going to be better than an office complex, that sort of thing. No, there won't be a lot of loud sirens. And so you got to deal with that. Then when, you've got sewer drainage and, I forget, and, parking ratios and impervious cover. And it's all this stuff they tell, so you do these plans, you spend, $100,000 or so doing a set of plans. Then you continually revise and you present them to, well, you've been there all the time. You present them to ZAPCO, the zoning and planning, or to city council. Usually you do zoning and planning first, then it goes to city council to supposedly rubber stamp. We never got the rubber stamp because certain people just did not want our little township to grow. It was on the periphery of Austin, just didn't want it to grow. And it was, there's no stopping it. And so, but we were early in the game. This was 25 years ago. So we just had to show them what we were going to build, why we were going to build it. You have to sometimes talk personally to each member of the council. Often we had those personal talks and it just didn't matter what we said or how noble we may or may not have been. We weren't going to get their vote. But eventually we got it. So it's politics. It's trying to do the right thing. It's a compromise. You give up this to get that. There were height restrictions that we had to abide by that we would prefer not to, would have cost us less money. We did things like digging into the hill, which cost us a lot more, but it kept the profile of the buildings lower. We staggered the buildings to save trees. So I know I could keep going, but it's those sort of things. It's little details until 5 out of the 9 people say, okay, these guys might be crooked developers, but we're going to let them build this thing. That's what they call you, and so it worked out. And it's an award-winning property, and they're all happy we did it. And they all took credit for building it once it was done.
Oh yeah, of course they did. They were probably ribbon cutting ceremony, wanting to get their picture
Absolutely.
and everything.
Yeah. But it's gratifying because it's the true value add. It's a piece of dirt that we cleaned up and put a really, the improvement is basically a bunch of new buildings, and we now have it serves a lot of the community now.
Yeah, I think that sometimes it's hard for people to get past, the initial change because change is scary to a lot of
Yeah.
people, and that's usually a big holdup, especially in the development world, is that convincing people that the change is a good change or showing them that it's going to change whether they agree or not, and so why not stay ahead of it and embrace the change? Here, we're actually going through something similar. We had a casino that got approved to go into former mall space, and they're like you said, a lot of pushback with people not wanting the casino, for many reasons. Whereas other people are obviously pro bringing money in, creating jobs, revitalizing the mall area, and tax benefits, all of those kind of things. And so it's kind of that meeting of the minds, and how can we all make something work that maybe isn't ideal for everybody, but you can all coexist together.
Yeah, it's a good point. There's really in that situation, no real right or wrong answer for everybody.
Yeah,
So
yeah,
compromise again. Yeah, good
exactly.
point.
Exactly. So I'm interested to know what your favorite asset class has been that you've worked on. So you've done a little bit of single family, condos, apartments, hospital. You said you did a little bit of extended stay hotels, and
Yep.
now you're kind of more so focused on existing apartments. So
Yep.
what has been your favorite thing to work on, and where do you see do you envision your time now completely just being spent on apartments?
So I will say I really, really enjoyed doing the medical center but I was in total learning mode. It was so much fun. I was deep into my practice. I mean, I hadn't been practicing that long. I'd probably been practicing only about, 7 or 8 years when I started this project. So it was exciting for me to learn. It was really fun. I'm super proud of it. It runs without hardly any of my activity. So that's nice. And medical is awesome. Uh, doctors don't move very often because they get known for their location. And so it's a really stable asset class. It did great during the great financial crisis. It did fine during COVID. Little bit of trouble during COVID. So I enjoyed that. That being said, I think I've already tipped my hand because I've pivoted from development into apartment acquisition. So I do believe that there's there are all kinds of demographics I could talk about. There's a huge wave of supply coming, but it's peaking right now, and I we are still underbuilt for apartments. That's why I like it. I like the general trend, and if you find a region or a local area that's not heavily oversupplied, there is always going to be demand for a place to live. Uh, Rent growth is not always going to be lightning fast. Sometimes it's really slow, like it is now, flat to negative to barely growing. But I think over the long term, I still like the multifamily uh, because of number one, the demand, number two, the supply. We're still several million units down. Depends on where you are in the country, of course. And the debt is a lot nicer for multifamily. It's a little, I mean, you get debt for office products and things like that. You get debt for single family, but there are very nice debt products for apartments. And I like to keep my debt non-recourse, which is a good way to sleep at night. So I think I'm going to stick with that. Probably going to focus on that the next 20 years. It's going to have some ups and downs during that time, but that's my plan.
Love that. Is there a particular markets or markets that you're kind of focused on within your acquisitions?
Yeah, my portfolio stretches from the East Coast through Texas. So, Georgia, Florida, Alabama, Texas. We got rid of the Oklahoma and New Mexico assets, but Texas is great. It's growing like crazy. It's also hard to find a good deal in Texas. And we're heavily overbuilt right now. I'm in Austin, Texas, which is always number one this is on the list of people where rent growth is declining, or dropping. Not rent growth, rents themselves are declining, but it'll bounce back. So we're mostly in the Sun Belt. That's good news, bad news. That's where everybody wants to live. It's also where all the developers wanted to put all the units. But there's still not enough out there to cover the demand that's coming. So we think 2025 and 2026 are going to be good years. We think there's going to be demand and upward pressure on rents. So trying to buy things, it is difficult. There are a lot of properties there's some properties in distress. Mostly it's their capital stacks that are in distress. And we're finding deals, but even finding a deal where you can buy it for the debt that's owed doesn't necessarily mean it's still a good deal. So we underwrite 3,000 properties a year. So far it's August and we've closed on one deal. So we are looking for just sort of those gems and they're out there. So we'll probably stay in the Sun Belt. Like to get to the Midwest where things are a little more linear,
Yeah.
but we don't have a footprint there yet.
Yeah. Well, I'm interested to hear what your thoughts are. If you've maybe done a little bit of value add, what about office conversion? Have you explored that or thought about how that might look for?
Man, I don't want to get near that. After building offices and, we build medical offices. So there's a bathroom every 10 steps, it seems like, or there's a drain cut every 10 steps. It is quite difficult to take an office property and cut it up into a multi-tenant residential property. It can be done and it is done. People smarter than me can do it, but I don't want to have to be that smart. It's really hard to do. So if I had one, I'd rather either re-tenant it as an office complex or, turn it into storage or something if it fit that. But yeah, conversions can be done, but it's a very small fraction of what's happening to the office buildings.
Yeah. What about hotels? Maybe like a rundown hotel or motel. Would you consider converting those into studios or one bedrooms maybe?
I mean, I would think it's an option again, outside my expertise and my experiential time, but yeah, no, that makes a little bit more sense. They're small hotels. They may not have kitchens, so that's an issue you got to think of. You got the bedroom, you got the bathroom and sink, but you don't have a kitchen, so you got to think about that. And then, of course, if it was a multifamily property, you need to make sure it's in an area where somebody would want, to plant themselves for a year or more. So sometimes hotels are built in more transient areas.
Absolutely. Um, no, I think your strategy is spot on. I think, knowing that we are in a severe shortage of housing, and that our retiring population is the biggest that we've ever seen, and they're also going to need options once they can no longer live in their homes. And so I think we're going to hit this unique bubble where we have properties that have been, I don't want to call them maybe depressed, but um they haven't been upkept because these people have lived in it for 50 years, 50 plus years, and now they're going into nursing homes. And now the entry point at what those houses are costing and what people are making who would be buying those houses are so different.
Huge
And
gap.
there's such a gap there. And the young people who want to buy homes are kind of left with these fixer upper homes, but they can't even get access to these fixer uppers. And so we're seeing a generation that is continually being renters for much longer than we've ever
Right.
seen in past years, with home ownership levels falling. And so I think you're in the right strategy of knowing that there's demand coming there. So you know that the population is being driven to the Sun Belt areas, and you know that people are going to be forced to be renters for longer, and maybe even choose to be renters because they don't want to be
Right.
bothered with the home ownership.
Right. No, we agree. Yeah, the gap between renting and buying is huge. It's close, just under $1,100 right now, average nationwide. So they will rent longer. I mean, they won't forever, but as long as there's enough, and there's more coming behind them. So it's been a long time since we've actually caught up with the housing need. Certainly some areas in the Sun Belt are pretty heavily overbuilt, but again, they're usually overbuilt in areas where the absorption's high. And so that will play out over the next year or two or three, depending on the location. And developers, they go in when it's hot, they stop when it's cold, and it's so this kind of wave like so. So the deliveries are already dropping. They're just starting to drop now. So we're hoping it'll happen.
I definitely think you're on the right trajectory. So I like to always ask my guests what they're reading, and if they have a good book that they're recommending people check out outside of your own book, of course. But
Well, of course.
what are you reading right now, and what would you recommend our readers or our listeners take a look at?
So I just read, what did I buy? I'm looking at my Audible thing. I read The Art of Focus by Dan Coe and The Wealth Money Can't Buy by Robin Sharma. Uh, and then I read Gary Vaynerchuk's book, Day Trading Attention. I wanted to see because I just like joined social media like 4 months ago,
Yeah.
maybe a couple of decades late, but what the heck. But favorites for me, I try to read a lot of mindset kind of books, and sometimes, like stuff like social media there, learn something from a guy who does it. But I like, certainly I've read a lot of the real estate books. I do. I mean, for anybody that hasn't, Kiyosaki's books, Rich Dad Poor Dad, followed by Cash Flow Quadrant. It's a 1-2 punch that's really important, especially for professionals. I actually helped edit Cash Flow Quadrant.
Nice.
Anyway, but currently, a couple of my favorite books that have really helped me is Who Not How by Dan Sullivan and Ben Hardy. I'm a professional. You are. I don't know if you were like me, but I wasn't good at delegating, and so I still work on that problem of mine. And Gap in the Game. Again, Ben Sullivan, uh, uh, Ben Hardy, Dan Sullivan. Sorry, uh, Benifer. But that was really helpful. The Gap in the Game is just a really good way to think about things. And goal setting. We all set goals. Sometimes we want to get to 100, whatever that is, and we spend a year and we get to 70. And you can look at that two ways. Either you can look at that as a failure, or you can look back and say, "Hey, I started at 0, I got to 70." That's gain thinking. Or if you think I didn't make it to 100, that's gap thinking. So, always be grateful for what you have and what you've accomplished, and keep trying to build on top of that. So those were two really good books. I enjoyed those.
Yeah, I definitely, I'm right with you. We're reading the same kind of books, and I'll give a plug out. I'm not sure if you know Tom Wheelwright or not.
Tom is my CPA.
So
So
I just, I was reading Tom's book earlier. I love
yeah,
talking how to, like we were talking, not pay taxes legally, of course, and how to structure businesses, how to structure real estate assets in a way that's favorable based off of what the tax code says. So that's
Right.
currently the book that I'm reading, along with one of Donald Miller's books, How to Grow a Small Business.
Ah,
So I recently purchased a franchise, and so I am looking to build a different type of business outside of real estate, but
all right.
it's a company called Everline, and we do parking lot maintenance and repairs, and they're actually headquartered in Austin.
Wow, nice. Good for I like the franchise idea. It's a lot of hard work, and if I was younger and had more energy, I like the franchise idea because you roll those up enough, you can have a nice exit.
Yep, and so that's the game plan. Buy businesses, create businesses, buy real estate, and grow wealth. That's the name of the game, right?
Yep, absolutely. I've got a fellow in my Tiger 21 group who just built car washes and didn't build many of them and sold it and never has to work again. So uh, good luck to you. Keep building.
Yeah.
Keep repairing those parking lots.
Well, Tom, leave us with maybe one final nugget or one final piece of advice that you think our listeners should heed on.
It always seems daunting. It's that old how to eat an elephant thing, right? It's one bite at a time. Just always try to tell or suggest to folks to just try to get a little bit better at whatever you're doing, whether it's parking lot franchise or learning real estate or being a doctor or lawyer, whatever you do, just try to get a little bit better each day. It doesn't have to be huge steps. It's the Brian Tracy thought, 1% better each day. And you'll be surprised how that compounds over time. And the same thing happens with your passive income. If something would make me $1 a month, I'd buy it. I'd take it. If it was positive, passive cash flow, I'd take it. That dollar one day turns into 10, 100, 1,000, and all of a sudden 20 years later, that thing's putting out a lot of money. So try not to eat the golden goose, keep rolling things back into your investment vehicle. Um, don't get don't get too don't try to make it happen too fast. We all want it to happen fast, but that compounding will come faster than you think. We overestimate what we can do in a year, we underestimate what we can do in 10 years. So have faith, keep doing it, keep getting better, and you'll get what you want, whatever it is your goal is.
Well, Tom, can people follow you now on social media now that you've joined the rest of society?
They can't. I know I'm such a dinosaur. So I'm mostly just on LinkedIn, and I think I have a Twitter account. Or X, whatever I'm supposed to call it. And I've got a Facebook account, but I don't put anything out there yet. But yeah, I'm on LinkedIn, and I put real estate tips, mindset tips, things like that. I also have a newsletter that I write weekly, which has got a lot of tips. And if I may, just go to richdoctor.com/newsletter. And, your folks are welcome to get on the newsletter. It's free. There's no spammy stuff. It's just real estate things.
I love that. That's awesome. Well, Tom, welcome to 2024 and social media age. And I will be following you, and I'm
All
excited
right.
to see how your journey in the apartment acquisition goes. And it was so great having you on the show today.
Thank you. I appreciate it. I really appreciate it. It's a good thing you're doing.
Oh, thank you, Tom. And for everybody out there, that is the wraps for this episode of Inspire Wealth. Thanks for listening, and we'll see you next time.